Greetings in the love and light of the one infinite creator. I'm Andrii Zvorygin, and today we will be seeing presentations from Art Berman, Steve, myself, Simon, and hopefully Jean Laherrere if he manages to make it in. Okay, so go ahead, Art.
Okay. Everybody seeing that?
Not yet.
I'm not seeing it. Okay, try share screening again.
Okay. Okay. Share window. Share this window and
There.
We can see it.
Yeah.
okay.
There.
All right.
Now
So
it's
this is
full width. Mhm.
this is just a brief couple of slides here, 6 or 7 of them, to update on what I've been working on, which as a lot of this is captured in a recent post I did, which is called The Energy Transition That Isn't. Basically, there are a couple of points here. I think the peak oil part is the part that I'll get to kind of quickly, but talking about net zero, basically the cost of doing this is somewhere around $6.5 trillion per year by 2030, which climbs to about 8 trillion by 2035. That's roughly 5% of global GDP annually through 2050. That's not going to happen. We're still having committee meetings to talk about whether climate change is real. So I don't think this is probably feasible. Basically, also climate concerns are taking a big backseat to other more pressing issues: the economy, tariffs, trade wars, inflation, etc. Big oil, many of the big oil companies, particularly in Europe, had adopted a climate-friendly perspective as of a couple of years ago. That's pretty much gone. Big oil is back to doing what makes them money, which is to say oil. The peak oil talk, for reasons we can discuss later, has somehow shifted to peak demand rather than peak supply. To me, they're end members of a spectrum and are therefore inseparable. And if anything, we still should be talking about peak supply because that's what markets focus on. And that's not because they care particularly, except that markets are able to control or at least modulate supply with price, whereas not so much with they can't have very much effect on demand, not to mention even our central banks are not very good at that. So where I come down on this is that instead of debating what I believe is a fantasy transition to renewables, we should be focusing on the real shift ahead. And that shift ahead is the end of both oil supply and demand growth. And that's going to trigger a massive system shock. And again, I'm not subscribing to the symmetrical Hubbert type of peak and decline looking mirror image as the rise did, but it doesn't matter. Once oil growth stops, then we get the system shock, and it won't be felt at once, and it won't be felt evenly across the globe, which is part of the reason that we're seeing the kind of competition between various blocks in the world right now. This system shock may restore balance to energy use, economic growth, and the destruction of the biosphere. But in the short term, what I expect is an upheaval that will make today's economic and geopolitical turmoils look like a Sunday picnic. So this is the first slide that I think is important. This shows world liquids production. And what I've done here, this is just EIA. I'll show you others in just a moment. What I've done is I've taken their low economic growth scenario, which seems to be the way we're going, and I've simply anchored it at their 5-year increments, merged that back with historical production back through 2024, and this is what it looks like. It looks like essentially flat for as far as I've taken this projection, which is to 2040. the actual number is 400,000 barrels a day over 15 years, which is essentially zero. The important thing to notice, though, is the average annual growth rate in supply was almost 1.5 million barrels a day up through 2018. And the projection is that it's going to be 0.03 million barrels per day. So that's a huge change in the way the world operates. The next slide shows exactly the same data for the EIA in blue, and I've just superimposed IEA's forecast, their actual scenario projection, and this is for what they call their stated policies, not their net zero or any of those. This is just based on what countries say that are committed to at this point. So EIA says we're going to be basically flat for the next 15 years. IEA says we're going to fall 6 million barrels a day by 2040. Take your pick. They're both, I think, rather gloomy for the maintenance of the civilization that we're used to. And my view on this is renewables can grow all they want, or all that we want. But wind and solar won't power the 4 pillars of civilization, which are steel, concrete, plastic, or fertilizer, not to mention the global transport network that keeps everything moving, including renewables. Consumption looks relatively similar. I'm not showing the individuals here. The blue is EIA. EIA expects consumption or demand to increase about 1 million barrels a day by 2040. IEA thinks that it'll rise a little faster than EIA, peaking at about 106 million barrels, again, we're at liquids per day by 2040, and then declining 2.5 million barrels a day after the peak. And then the last 2 slides, this is US production since 1900. And what we can see then is the 1970 peak here at roughly 10 million barrels a day, the attempt at moving back toward that peak with the discovery of Alaska oil. US then became a big importer. US production dropped to a little over 4 million barrels a day. By the great financial crisis since then, it's climbed to more than 13. Now, if we break that out into its components, we can all see where that's come from. Not that it should be a surprise to anybody on this call, but right now, tight oil is 67% of US production. So that is what I have to share today.
Okay. Thank you. And well, for me, those seemed like fairly optimistic, projections. But what do the other experts here think? I don't, Charlie. I don't know if you had a chance to see it, or Simon.
Yeah. Good. Art, does that include natural gas liquids? Because natural gas liquids provides now almost a third of U.S. quote unquote oil.
Well, yeah, it does. I mean, that's part of the definition of
The condensates includes natural gas.
No, condensates are not natural gas liquids. Condensates are oil that is a gas in the reservoir which condenses into a liquid at surface pressures and temperatures. So condensate is not different than oil, except that it has a slightly higher API gravity. Natural gas liquids are a different deal. Natural gas liquids
understand.
Yeah.
But they're included in your graph.
Well, it's not my graph. It's it's how the world counts oil, and again, my broken record point to this group is that we might make some distinction between this type of oil and that type of oil, whether it's fracked or conventional or whatever, but none of us on this call buy oil. In fact, the only people in the world that buy oil are refineries, and refineries couldn't give a rat's ass if the oil is natural gas liquids or fracked oil or unfracked oil. They're like when I go to the grocery store. I mean, I want a certain volume of something that has a certain property to it, and if the refinery is looking for an oil that has 35 API gravity and the price is right, they don't care where it comes from, because they're looking for the combination of utility and value, which is price. And so this is this whole conventional unconventional thing is an intellectual construct that doesn't exist for anybody who actually buys oil, which doesn't include anybody on this call, including me.
But the reason I'm asking this question is that I understand, and I'm not an expert on this, but I understand that our refineries, due to EPA restrictions and so forth, operate mostly on heavy oils, and increasingly we produce light oils like tight oils.
No, that's incorrect.
And that we export a lot of our. Okay, that's not true.
That's completely wrong. I mean, these are memes. These are peak oil memes that aren't true. Refineries, every refinery is a little bit different. Okay, U.S. refineries were originally designed to optimize for gasoline production, and U.S. oil is just Jim Dandy for producing gasoline and plastics and all kinds of other stuff. And then at the time that the U.S. became a big importer of oil, a lot of the available imports, which were largely from OPEC countries and Canada, were heavier. Okay, and so U.S. refineries re-engineered themselves to accommodate this heavier oil, not because of anything the EPA did or for any particular preference. It was just that looking into the future, they said, hey, U.S. production's going downhill, and where are we going to get our oil from? We're going to get it from somewhere else, and the character of that oil is heavier. Now, just because that happened, U.S. refineries still use a heck of a lot of U.S. oil, which is light. Okay, but they also bring in the heavier oil, some of which is not very much heavier at all, some of which, like from Canada, is considerably heavier. And all they do is they take that heavier oil from Canada and they put it into a different part of the refinery, which is called a vacuum distillation column, rather than an atmospheric distillation column. So the atmospheric is, as you might imagine, open to the atmosphere, and so it's at standard pressure, whereas the vacuum system is at a much higher pressure because they suck it down, and that allows them then to use various catalytic converting processes to take the heavier oil and convert it into diesel and kerosene, jet fuel, and even gasoline. So there's a lot of misconceptions, and I don't want to, I'm not going to misrepresent myself as being a refinery expert, because I'm not. But, if you go to some other part of the world, if you go to Europe, guess where our biggest exports of light oil are? Europe. Okay. I mean, the Netherlands is the biggest importer, other than Canada, of U.S. oil. So, I mean, this is not some uniquely American deal. I mean, gasoline is a cash product, and Europe is a net exporter of gasoline. They love U.S. oil. They love it. They love the light stuff. The Latin America loves the light stuff. Most of the oil that comes from West Africa, Angola, Nigeria, it's light too. So, we got to get away from these distortions that say that somehow, there's this, there's this papal line of demarcation between the U.S. and the rest of the world. There's not. Okay, and the other thing that's important is that the growth in the oil markets, at least as viewed by those who refine it, is in the light stuff. That's why you're seeing more and more natural gas liquids. That, as assuming that the world does convert to renewables, at least for EVs, at some increasing rate, then more and more of the crude oil in the world is going to be used for lighter products like plastics, and that's going to make lighter oil, like what's produced in the US, even more valuable. And the price for light oil is much higher than it is for heavy oil, because heavy oil's crap. Okay, it's not very good. You have to put it into a special distillation process with all the cat converters. So there's like a $15 or $20 discount for Canadian oil to US WTI because it's crappy oil. So, I mean, again, I'm not taking a side here. This is just the reality of the way it works. So the idea, that somehow all this shale oil, first of all, it's not any different petrochemically from the rest of US oil. It's exactly the same. And the other thing is that it's not useful is a complete, it's just not even close to true.
Well, this wasn't what I was saying. What I was saying was that I had heard, and I think you're refuting this, that U.S. refineries are better able to use heavy oils, and we're producing more and more light oil. And so we are importing more heavy oil from, e.g., Canada, and exporting a lot of our light oil. And I think you're saying that's just market situation?
What I'm saying is that the way US refineries are designed, we have used increasingly more of our own domestic oil input into those refineries since shale started. We've now reached a maximum, okay? We can't, unless we build more refineries, which we're not doing, or re-engineer those refineries, which we're not doing, then there is a maximum, okay? But the US net imports have dropped from 12 million barrels a day in 2008 to 2 million barrels a day.
Yeah.
Okay, so now that's a net, but so the trend is that the US, whether we like it or not, is far more oil independent than it has been in any of our lifetimes.
No, I understand that. But are we producing enough of our own diesel? Can you produce diesel from light tight oil?
Well, it depends on, again, there's no, it's like, does everybody on this call as a human being have exactly the same body chemistry and DNA makeup? No. So you can take the Bakken and you can make diesel out of the Bakken because it has the necessary middle distillate chains. You have more difficulty with the Permian and even more with the Eagle Ford. But it's not, it's not a binary system. But no, if anything, there's a glut. There's too much. There's too much diesel in the world right now because places like China are actively converting their truck fleets from diesel to compressed natural gas. And that's not, again, China's not doing any of this because it wants a clean environment. It's doing this because it's in the same sorry position the United States was in 2008, that it's importing 3/4 of its oil. And it's trying to do everything it can to limit those imports. And one way to do it is to mandate that trucks not use diesel. So diesel demand is declining in China. It's declining in Europe because Europe is deindustrializing. Europe is suffering from high energy prices. So overall demand for all petroleum products is low. And so the model that we all had in our heads 20 years ago, that somehow oil prices were going to go to $200, that just doesn't seem to be working out. Price of oil keeps going down. And in fact, the average price of oil since 2000 is right about what the price of oil is today.
Okay, thanks. And I see we have Jean Laherrere joining us. Did you want to test your audio, Jean? Not sure with.
Well,
Oh yeah,
I don't know. I see
we can hear you.
my face, but well, okay.
He has to share his
Very
screen.
good.
There you go. Hey,
Hey, Jean.
hey, Jean.
Yeah. Did you hear Art? Well, what Art was talking about? I don't know if you had any comments.
Yes.
Mhm.
I did.
Okay.
I did. The thing is, as far as I know, but I am a geologist, U.S. refinery used to be designed to use heavy Californian oil. So the title, the LTO, is not it's not very good for U.S. refinery. It is why they need the Canadian oil sand.
Mm-hmm.
Now, U.S. refineries were designed for WTI, which is on average 45 API gravity. That's the standard oil of the United States, not just California. And tight oil is exactly the same. It is geochemically identical to conventional U.S. oil. So nothing has changed. So the only thing that's different about tight oil or shale oil is the way it's drilled and completed. The geochemistry is not any different from the oil that was drilled and produced in vertical wells in Oklahoma, Texas, etc., forever and ever. This is a myth. It's not true.
Okay. So, Jean, I know you had some slides you wanted me to share on your behalf. Did you want to start that soon or now? Or when would be a good time for you? And Jean.
What do you mean?
Oh, well, you had some graphs you wanted me to share.
Well, yeah, the one I did on U.S. Oil production forecast.
Here, I will try to get them.
There we go.
Is that the right ones?
Yeah, but it is the one.
Is it these ones?
It is this one, and yeah, it is this one, and
Okay.
you can see for the Texas, which is mainly Permian, that you can see that we are supposed to be at peak, and the decline will be as steep as the increase. So, in 2040. Texas crude oil will be down to the production that it was at 2000. It means very low, or it was in 1930. So where they are going to find oil to feed the Texan car?
Mm-hmm. I see. Did you want me to go to the next slide, or you want to have comments? Or
well, I would like to see the reaction of
okay.
people
You'd like to see the reaction.
at the decline of U.S. production forecast.
Okay.
Do they agree
because I know
on
you.
that? It's when you look at the IEA forecast, it's going. They don't see any peak before 1940. When I see the peak in 1930, so EIA forecast is completely unreliable.
Mm-hmm. Okay. Yeah, that's fair.
If you compare with IEAs in Paris they are putting a peak before 1940, contrary to the EIA.
Okay.
I showed IEA, and IEA looks just like EIA. No, I showed it. Did you see it? I'll be glad to show it again.
Oh. Okay. Yeah, you're. Well, in terms of their projection, I think he's talking about 1940.
I've got it.
Okay.
Well,
All right. Sure. I have your share screen up here. You just need to. Oh, I see. Jean Laherrere is sharing his screen. Oh, okay. Okay, that's not. I thought that was Art's screen. Okay.
so this then
Okay,
is okay. So here we go.
Hold on, it's still loading. or I'm all I'm seeing is a black screen right now.
All right, let's try it again. Oh, somebody's still sharing. That's the problem.
Here, yeah. Okay, there. Oh, I can see myself now. All right.
Okay, share window.
Oh, that's Jean's screen. Okay, there, Art.
Okay, so let's try this again.
It's still black though.
Huh. Well, I don't know what to tell you. Show me what you're. Oh my God! Look at that. That was really weird.
Okay, that's Jean's screen.
All right, start screen sharing. Share window.
Jean, can you stop sharing your screen? Maybe it'll make it easier for Art. Yeah.
Well.
Okay. Well, it looks like we're in some technical difficulties.
I don't know how to do it. You see, I'm not very clever. Don't
Okay.
forget.
So he's still sharing.
94 in 2 months.
Andre,
right.
I think you should be patient because this is an important issue. I'd like to see I'd like to see Art comment on John and John comment on Art. I think that's important.
Fair enough.
My comment.
So
Joe.
Go ahead.
Yeah, my comment on John is that's what you show is not accurate. I mean, we're still increasing production after your peak. I think your peak is like in 2020 or 2021, and production has continued to increase.
No, it's 23 my peak.
Well, we're past 23, and
24.
oil.
But for me, if it is what you have shown on the variation for 2042 is less than 5%, but 5% is the accuracy of the data in the world is less than 5%. So any change of 5% for me is about the same.
Okay, that's fine. But my point is that, I mean, you can't just say that EIA and IEA, don't know what they're doing, that their numbers have to be disregarded. I mean, that to me, that's like saying, well, it can be whatever I want.
No, but it is. I'm talking about the energy information administration. I'm not talking about the international.
All right. Well, so let's see if I can share now. Share screen, share window, share this window. No, it's not letting me share. Somebody's still.
Yeah. Okay.
No, Jean's still sharing.
Yeah, Jean. So can we just get this technical issue out of this way? So in your browser window and the bottom, there's going to be several icons like your microphone and your video. And the third one is the share screen button. So if you just click on that, it'll stop sharing your screen. Okay, and it should make it easier for Art to share.
What do you have? I have to do. I don't know.
So if you're
the middle of the bottom of the screen.
Yes.
So yeah, you're almost there. Okay, that's the chat.
Open chat.
Okay, just
Left.
go to no. Go. Okay, the third button. The third button. It's got an arrow in it.
That.
Yes, that one. That's the one. Click on it. Yep.
Stop screen.
Yes, very good. You did it.
Okay.
Okay, good. Okay, Art.
Now he's still sharing.
Try again.
Well, it looks like he's still sharing.
No, he's not. Now it's you that's sharing. So you gotta stop sharing. Okay, very good, Gene. It worked. Is Gene still with us?
It's not working.
Oh, he's still here. Oh, okay. I'm not sure why it stopped working. If you want, you could try refreshing your browser. But otherwise, I did have some more slides from Jean.
Okay. Well, my point is simply this, and that is that if you want to say that all of the independent agencies, if we ignore their data, then you can be whatever you want. But IEA, EIA, if anything, IEA is more optimistic about the present than EIA. So if that's Jean's point, that we need to throw away the EIA then fine, I'll just use IEA, and IEA still says that his, the shape of his decline is completely wrong. It's not true today, and IEA says it's not going to be true in 2 years, 3 years, 4 years. I don't care about 2040. 2040 is too far to know. It's just, you can't base the future on a purely statistical model that says that it's going to fall off a cliff. I mean, there's no indication based on current production rates of crude oil, of natural gas liquids, of anything you want. There's just no indication that we've reached a peak or we're approaching one. I mean, that's not a preference of mine. I would love to see oil production go down. I'd love to see consumption go down, and maybe we can get the world back where it needs to be. But that's just not what the data says. So I'm just going to leave it there.
First, the data from EIA are not measures; they are just estimate.
No, that's not true. The
form 914 is just estimate; it's not measure.
No. Look,
look at EIA form.
You look, if that's the estimate for this month. But if you go back 3 months or 4 months, it's not an estimate anymore. It's hard data. Look, all these agencies, they gather data the same way. Okay, they all have to do a survey because nobody knows precisely what the production is right now or even a month ago. But 3 months, we are in the 90% probability that we know. 6 months, we're in the 95%. And a year, I think we're quite sure what's going on. So, I just don't, like I said, if you want to enter the world of fantasy and say that everything is a guess and we don't know anything, well, I mean, that's true for what we did in 1950, what we did in 1910, what we did in 1980. We're always guessing a little bit, but it's not complete. It can't be whatever you want. And all you have to do, Jean, is, count the tankers. Go to the Persian Gulf or go to the Gulf of Mexico and count the tankers that are leaving full of oil. You can't ignore that. We know
I
what
don't
that
ignore,
number
but
is.
Art, for example, when I say I don't trust EIA for Permian, so I go to Texas Railroad Commission, which is more reliable than IEA, and it is where my data. Look at my Texas forecast on crude.
Where do you think that the EIA gets its data? They get it from Texas. They get it from North Dakota. They get it from Oklahoma. They don't.
Yeah, the way they report this. Okay.
Yeah. Okay. So I have a question. For Art and others, in terms of that, I know the Permian, it was like 100,000 kilometers or something, and its total URR was like you were showing us it was 70 or 90, so it's basically 1.5 to 2 years of global oil production. And so that, Art, you said that it peaked last year, and it will plateau for a while. We know that. But I'm just wondering.
I didn't say it peaked. It hasn't peaked.
Oh, that was my impression. Maybe I misunderstood.
No, what I said was that average well performance is declining, but overall, right, and it hasn't declined very much. But it is. I mean, and I showed this data at one of Charlie's meetings a couple of years ago. I can't remember where it was, Philadelphia or somewhere, but Permian production is still increasing, and the best estimates, looking at Tad Patzik's work or looking at the oil industry's work, is that it won't peak for another 5 years or so. So, and I think, Andrii, this idea of taking the total production from a play or a field and dividing it by world consumption is it's kind of a bogus way to think about it, because if you did that for any field, you'd say, oh, let's just forget it. I mean,
That my point.
nothing's worth it if that's the case. But I mean, so there's 25 billion barrels of tight oil proved reserves. 25 billion barrels. Okay, so you can take whatever number you want, and that's more than a year's worth of oil production. But again, that's to me that's a silly way of figuring it. That's not the way it works.
I'm looking at the global perspective, right? And so I'm just thinking that if Permian has or is close to reaching a plateau point, then what is the next big play that will offset conventional decline?
Well, but I showed that the last time we were here, and I showed that there are 100 billion barrels of other undiscovered or unproven oil in the United States by U.S. Geological Survey estimates. Now, I'm not going to pound the table and say I believe that number is absolutely correct, but I promise you that we're not running out of oil. I mean, the IEA, estimates, again, forget the EIA, the IEA estimates that, we've got something like 60 years of proved reserves if we don't drill another well, if we don't discover anything. And again, I'm not trying to be a cornucopian. I'm just saying that, these are reasonably firm numbers. I mean, cut them in half if you don't believe them. We're not running out of oil. We're just not.
I know Rystad had drastically lower proven reserves, and they consider the BP and the IEA numbers to be mostly speculative. But I know John has his hand up, so I want to let John answer.
Sure.
Well, the thing is, proven reserve is just a very poor way to look at reserve, because prover is supposed to be 50% probability, minimum probability, 10% probability. And
that's not true.
Well, not true, but anyway.
Yes, that is usually the definition. John is correct.
Well recognized that the aggregation of proven reserve is completely wrong. You can only aggregate proven plus possible. It's mean value. Look at statistics. Just don't say it's wrong. It's look at every.
Who? Okay, let me ask the question. Who on this call has ever booked a proved reserve?
But you are talking about proven reserve.
Have you ever defended a proven reserve estimate that you have produced?
Well, first, Art, did you ever estimate reserve of discovery that you have made? I did.
Yes, I have too. And I will tell you that the standard for a proven reserve in the United States is far more than 50%. And not only is it a number, but it has to show a 10% present value rate of return for the life of the well. I mean, it's not some, it's not a magic trick. I mean, you actually have to, it's not 100%, but it's not 50%. I promise you, maybe that's true for the rest of the world. But if I go to the Securities and Exchange Commission and I show them what I call a proven reserve, and I tell them there's a 50% chance that it's real, they'll tell me, get out of here. We're not we don't talk about 50%. You've got to be, in that 95% category. Now, that's not a standard for the whole world, but it's true for the United States. It's true for Canada. I mean, you can't just make up what you think proven reserve standards are. I don't know what it is for Venezuela. I don't know what it is for, a lot of these places we don't know, but it's not some imaginary number, and it's certainly not 50%. Certainly not. That's just
50% is the 2P and the 1P. And like I said, we know there's different estimates, but so I see there's several hands up.
But 2P is not proven reserves.
Right.
No,
Two
Probable.
P is
it is
probable. And
proven.
Well,
P is
I'm talking
probable.
about proven. I'm talking about
IEA
1P.
proven
Well, we are
numbers
talking
are
about
exactly
proven.
the same as the 3P numbers from Rystad. So we have the Norway is giving us completely different answers that are very in line with what Jean Laherrere is saying, and they are completely different. So they do align with the 3P
Fine.
numbers. So anyways,
Well,
but let's get some new, because I don't want to go back and forth on this. Okay, let Jonathan Frost has a question, and then Dusty and Green, and then there's still some more graphs I wanted Jean to look at after. Okay, go ahead, Frost.
Hi all. So
We can't hear you. Sorry.
Oh,
I hear him.
yeah.
You can hear him. Okay. Okay, go
Microphone's
ahead.
on. And so, may I just summarize sort of what I've heard in simple language that sort of I can understand? I'm on my side screen. I've got one of Art's graphs of the United States oil production, and that I feel the nub of this is the peak oil, conventional oil that peaked in 1970 is a nice symmetric Hubbert curve. And that, as Art and Hubbert showed, a sum of Gaussians is a Gaussian. So all the individual wells added up to make one nice Gaussian with a full width half maximum of wherever it is, 50 years. Now, with the tight oil, what has been seen is a very rapid rise. And I'm wondering if some people are thinking about the Hubbert curve symmetrical with a very fast up and a very fast down. Okay, this is what I think people are maybe fooled by or whatever. Going back to Art's graph that I've got on the screen, I may or may not try and share it in a minute, but it seems to be technologically challenging today. But because there's such desperation to get oil production up, that rapid increase, won't necessarily, as I think it keeps on suggesting, because the oil producers are trying so hard, they're just producing more wells much faster than would lead to this symmetric fast up, fast down. I can logically see how to be fast up and then slow coming down, because you keep drilling hundreds and thousands of new wells to get towards that ultimate peak reserve.
So there are two components to the answer, Jonathan. The first is what you said, but the important thing is the technology. I mean, we are producing more oil in the United States than we've ever produced in history, with thousands of fewer wells, because the per well EUR is much higher, and that's thanks to the to the technology.
And that's the graph I was thinking of, which is from
we can
you.
see your share screen now, Art.
Yeah, so that's an old slide, but that's fine.
I get that, but fast up and a slow decay away, because as you said, keep pumping, make drilling more and more wells.
Cool.
Keep up. Thank you.
Okay.
That's all.
That's fine. That's good. I mean, I think it's fairly well established among most agencies that publish their work that the symmetrical fast up, fast down is not the most probable outcome for an infinite number of reasons. But so I mean, I have big problems with the Hubbert linearization model, which Jean and I have discussed privately, and I don't want to argue the details of them, but I mean, at some point, I mean, the Hubbert method was based on a world that was completely different than the one that we're in now, both in terms of the technology and also the financialization of the oil industry. I mean, the amount of capital that was available to oil and gas in 1970 or 1975 or 1980 was just, a fraction of what it is now. And there was no futures market. Okay, so oil price was something that was, quite well, mysterious would be one way to put it. But part of the reason that OPEC has been so massively unsuccessful in manipulating oil price since 2016 is because there's a futures market that won't let them do it. And they just gave up. This past week, they just said, okay, forget it. We're done with this. Everybody produce as much as you want, because they can't. And the Saudi oil minister, this, ABS guy, I mean, as far as I know, he's been chopped up into little body parts like Khashoggi was. I mean, we haven't seen him for years because he's been disgraced. I mean, OPEC cannot control the price of oil, and that's because the futures market is much stronger because there's a lot more money behind it. So I just think we have to acknowledge that times have changed, and they didn't change yesterday, and they didn't change 20 years ago. They changed 50 years ago, and we're just now getting around to acknowledging that, maybe things are not as we thought they might be. So that's and the speed of the up and the speed of the down is strictly a matter of how much money there is. I mean, the geology is only part of the story. Capital is a much more important part of the story today than it was 50, 60, 70 years ago. And that's not just true for oil, it's true of everything.
All right. So I wanted to give Jean a chance to finish talking about his slide presentation, because we kind of didn't even finish. So Jean, are you ready to do that?
Well, first,
just here are the slides. I'll show you.
Yeah, but first I have to ask.
Okay. Or yeah, first go ahead.
Okay. Well, just I want to. I don't know if my presentation.
Well, yeah, I could kick.
Yeah.
Here, yeah, if we could just go over these slides just so that I don't have them kind of hanging over my head. So what's this one about?
Okay, now let's. The thing I want to talk first. Well, I don't know. I don't remember too much on that thing. Oh well, okay.
Mm-hmm.
Now, where can I move the thing? Up and down. Okay.
Oh, well, I'm the one that's moving it right now.
Okay, can you go down? Can you go? Okay, now this one.
No, go down. Okay.
Look at the beauty. When in 1956, King Hubbert in this talk say it's going to be symmetrical, and he was talking about the production with the technique of 1956. It means that you have to look at the production of, which is in brown, the symmetry, and over 1970. It is a peak forecasted by King Hubbert was exactly there. And it is, so you see the symmetry is fascinating. And what it is fascinating, I don't know why you have two shoulders here, and they are exactly symmetrical. I don't know. When here you have probation, here you have high prices. It means that my explanation, it is in US, you have about 9,000 oil producers. It means that you are following the law of large number of production, which is not the case in Saudi Arabia, where is only one producer, Aramco. It means that the symmetry is due to the large number of production. But in fact, it is exactly when you look at the green, which is the production, the discovery shifted by about 33 years. It means that this it is here, the discovery, and if you shift by 33 years, it means that you are perfectly match of symmetry. It means for me it's fascinating. And so it is something that you find exactly, if you look at, for example, at production of anthracite in US, and it is exactly, you have a perfect symmetry of sort also of production. It is the same for the coal production in UK. It means that symmetry exists in very many on many items. So okay, now if you go, if you apply my assumption, which that the decline is going to be symmetrical of the increase, it means that you can forecast the production for energy for the world, and you can see where the green, it is a forecast by the World Energy Outlook from the IEA. It means that not very bad, not very bad. Now, if we go down, it means that you can forecast symmetry for the whole, for the coal, for the hard coal, and for the brown coal. Now it means it is the same for the world. So you can see you have the liquid in blue, in green you have the conventional oil, in brown you have the natural gas liquid, in purple you have the LTO, the SARS, what that called the SARS rock, and in dark you have the extra heavy oil. It means this seems to be very good forecast of the future. Now, if you go to the gas, the gas is fairly more easy to see that the increase from 1960 from today, it is this increase will be peak in 2040, and the decrease will be about symmetrical. That's mean that now for US, again, it is a primary energy. It was funny to have a fairly flat from 1970 to 2010, and with shale production, you can see it completely different way. Means at the present time, this it is a forecast of the EIA. You see no peak before 2040, but look at my forecast about 2040. It means completely different from the EIA forecast. It means that the US in 1940 will have trouble. Okay. Now. Let's okay down. Now it is the consumption. The consumption of US is flat, but at the present time, production is good. So you have exporting energy. You are selling a lot of gas very cheap. You see, it is. I am amazed that at the present time, the US, the price of gas, which is 1/3 of the US energy use, is about 4 times cheaper than the rest of the world. It means that the US at the present time has very cheap gas energy compared to the rest of the world. And I don't know if this will stand for long. But at the present time, you are very lucky. Now, you can see the US fossil fuel. It is amazing. You have an increase here, completely flat, and going up very sharp. But, okay, the decrease will be sharp. And I am afraid there will be no more other fuel to save US. So, now this it is You see in blue you have the production going up. You know, in red it is the consumption flat, and I don't know if this is going to be decreased, but anyway, assuming my symmetry, it's meant for a long time the US will be having an excess of energy, but it will stop someday. Now the problem is that on the beacon on the Narcota, I was wrong for a long time because I didn't realize that the producer was able to refract old wells and getting more oil than before. It means the US producer are very good. And but one day, the thing was my theory that they are not going to have more production because they will be lacking new location. But the production, they don't need new locations. They can refract all wells and get more oil because, as you know, you produce only a small percentage of the oil which is in the ground. It means that you can put more. So they were pretty good. Now, okay. In fact, this graph is wrong. I have a new one because the data for RSC was wrong. It is more that, but you see, EIA is
this the?
I send you a new one that I did this morning.
Yeah, these are the new ones.
Yeah.
This is the new one you sent me. Is this correct?
No, the new one. The new one that I send you is.
Well, this is what I got in my email from you this morning. So.
Yeah, it is this one.
Anyways, okay. So
I use this one, but anyway, it's not.
Sure.
Okay.
All right.
So,
okay.
any comment of my graph?
All right, I have
on my assumption that the decrease will be symmetrical to the increase. For me, it can be worse.
So I have.
If you look at the Seneca cliff
question
to
from Roger. So Roger, did you want to unmute and ask your question?
Yes, please. Oh boy, I just lost the sound. Yes, hello.
Hello, Roger.
Can you now hear me, folks?
Okay, we can hear you.
Excellent. So yes, apologies, I'm in an airport, a little bit tricky. Andrii, thank you very kindly for sending the link and telling me what to download. And without my wife's help, I wouldn't have been able to do it. Can you all hear me for the moment? Art, can you hear me?
I hear you fine.
Thank you, Art. Okay, short and sweet. Yes. Short and sweet. After your previous, the post about memes, and then the previous talk like this, I did sit down and write quite a lot of detailed comments. Art, you are a scientist, and I'm very appreciative of that. It's quite a long document I've put together, Art, discussing the places where I think you're quite right, but also, if you don't mind, Art, the places where I think you have some misunderstandings for completely understandable reasons. Can you still hear me, Art?
Hearing you fine, Roger.
Jolly good. And so the information I'm providing is based on the fact that we have been very privileged to have had access to that oil industry, oil discovery data, petroconsultants, Rystad, Wood Mackenzie, Global Shift, all the very expensive $100,000 E&P data, $1 million for the whole data sets. We've been privileged to have access to that, John and Colin and me and so on. and it does give extraordinarily a very different view. So what's happened is I wrote it all up. I only finished it just before I came to this ASPO France meeting we've all attended and Jean came to. It's now with Art, it's now with Charlie Hall and Jean to make comments on. When they've come back to me, I would love to send it to you. It's quite long, quite detailed, but it's really, I think, very solid, if you don't mind, and ask you to kindly look it through. Do you think you might be able to do that?
I'd be thrilled to. That'd be great.
Okay, that's all I need to ask. Andrii, thank you for inviting me. I'll stay on the line for a little while. It's a bit difficult at the airport. I can hear the children crying. I think it's going to be a useful content.
We can hear them too.
And I think it's going to help the discussions going forward. Thank you very kindly.
Thank you, Roger. Very good.
Okay.
So I would
Sounds
simply
good.
add to
Charlie.
Jonathan. Sorry.
Okay.
Jonathan's comment. You have to look at you have to look at population. Okay. So, I mean, the world population is the reason for the rapid increase in oil production. And so, I mean, when the year that, when I was born in 1950, the world population was 2.5 billion people. Okay, we now know that it's 8 billion, so it's more than 3 times larger. And so the increase, the fast increase in oil production was due to 2 factors: a rapid increase in global population, which was directly related to an increase in reliance on oil versus biomass, coal, and etc. Okay, so now to have a symmetrical production profile, we have to assume that somehow the conditions today are similar to what they were during the rise of that production curve, which they're not. There's 3 times more people. Now, Jean may argue, oh, well, that's a good reason why it should decline much faster, because we have so many more people sucking through the straw of existing production. My only point is that if you take something, a symmetrical growth curve that existed, that developed at a time when global population was a fraction of what it is today, then you have to somehow adjust for the fact that those conditions are no longer valid in today's world. And so I would say that if we assume that production, that population returns to 2.5 billion in, let's just say, 2100 for argument's sake, then I would agree that it's very likely that we'll have a symmetrical production curve. But the only way the population is going to go to 2.5 billion is if we have some sort of, nuclear war or cataclysm or massive starvation, and so I mean, I think that look at the projection from the United Nations or anywhere else on what population is going to do. And we can, we don't need to argue about the details of it, but nobody shows population dropping at the same rate as oil production. Everyone shows that we're going to reach a plateau of population, sometime in the next 20 or 25 years. And I think that it's empirically reasonable that on some level, unless we run out of oil, I mean, that's a different story. But I mean, the proven reserves that we have, and I'm talking about the 1P, even conventional 2P, are sufficient that we should have plenty of oil for, at least another couple of decades. So I'm done. That's all I have to say.
Okay. Yeah. So in relation to that, I got some nice graphs. So this is showing how oil production and population is intricately linked. And also this one that North Korea, when they had petroleum decline, their agricultural output had this exact same decline. And now I saw Jean. Did you raise your hand? Did you want to respond as well? Or and then I know there's Charlie and Patrick. And then I wanted to do a presentation.
Because about population, you see, the last time that the United Nations did they give their forecast in the past, I realized that if you look at the fertility rate, that you need to have 2.1 children per wife to keep the population flat. But 2/3 of the world population at the present time has a fertility rate of less than 2.1. For example, South Korea is 0.8 or 0.7. It means they are going to be toward extinction. It means in the future, the problem is that all the civil people outside the South Sahel is going to be extinct. And so the thing, it's for me, in the past, I was afraid that the end of civilization will be the end of resources, but now I am afraid that it's going to be the end of people. Now, the thing is, I found about few days ago, look at that in 1859, it was a big solar magnetic storm, and you know that, for example, in Quebec in 1990, some of the Quebec electricity were shut down for 1 week. But if the event of 1859 occurred again, it's going all the burst of all electricity plant and then all the computer will be gone. So I am afraid that what I am the most afraid is now is about when is going to be the next solar magnetic storm, and they say it's happening about every 150 years. So my new worry is about when is going to be the next solar magnetic storm.
Well, and I agree with that, John. I mean, and that's exactly my point, is that peak oil is probably not, well, I wouldn't say probably, it's not on my list of the biggest risks that are facing civilization in the next 5 or 10 years.
I agree.
Okay. So, Charlie, you had a question, and then Patrick and Hugo, and I have a presentation. And then if we manage to get to Steve and Simon, that would be great too. Okay. Charlie, go ahead.
I'd just like to say that I think the discussion between two people I admire greatly, which is Art and Jean, I think this is an extraordinarily important thing. I don't think it's not important. I'm going to send an email to everybody why I think it remains important. But let me just say, my minor claim to fame is EROI, the energy cost of oil, which I've studied over most of my adult life. And we have been saved in the United States by fracking, but we've been saved not only in quantity, but also quality. And I have, if I don't know if I'm going to do it with my hands instead of doing it with showing you the graph, because I'm going to send you the graph around. It's in a paper by Adam Brandt. And as far as I can figure out, the EROI in 2006, when we were still doing only vertical wells in the United States, it was down below 10-1 and falling. And with fracking, at least in the Bakken, and this is work done by Adam Brandt, who I think is really good. And we had a period, we have a hump-shaped, almost a Hubbert curve of EROI. And the hump, and it had a peak at around 2000 in, I think, 10 or 12, and then started declining as we moved off the sweet spots. even though the technology has improved, it appears that the EROI was going down, but we have data only to something like 2015. And we just don't have any money to do these analyses properly. Nobody gives a shit. And I think it's critically important. So, Art, there may be 50 or 100 billion barrels left, but we don't have 50 to 100 billion barrels of sweet spot oil left. And if the EROI declines, as if you want to extend that line, I don't know if you believe in that or not, but any extension of that line would indicate that our EROI of remaining trackable oil is likely to decline substantially. And I think that will be a very important thing. Now, I'm not saying I know what's going on here. All I'm saying is I think this is a really important issue that we should respect each other and try to get to the bottom of it. I don't like setting up Jean versus Art because I think they're both really good analysts. I think we have to sort our way with respect and good cheer or whatever you need to get through this issue, because I happen to think it's really, really important. And there is no support for doing this. And again, science is too often used to support a point of view rather than to test hypotheses. And we need to enter this saying, we don't know yet fully what's going on, and let's get to the bottom of it. And here's a colleague I may respectfully disagree with or not. And I've certainly been involved in all this. I have a piece in Nature Energy. I think it's just this week or month or something, where I'm disagreeing with some colleagues on methodology of EROI, but that's another issue. So that's my piece, and I will send around the publications that support my view. Incidentally, most countries who are nearing the end of their oil production go through beautiful Hubbert curves, Art. I don't know if it's going to happen for fracked oil, but for some 38 of 45 oil producing countries, you get a pretty nice Hubbert curve out of them. I'm sending you the data.
All right, thanks. Okay, so let's take a quick question from Patrick.
Yeah,
Patrick, can you unmute and ask your question?
Do you hear me?
Can you hear him, Art?
I hear him.
Because I can't hear Patrick. Yeah, you can hear him? Okay, good. Go ahead.
Okay, it's more a comment on the symmetry of the production profiles. In the US, I would like to make, but can I share my screen? I have 3 pictures to show to explain a bit better what I want to say.
Okay, yeah, quickly, you can share your screen.
Yes. Do you see this one? Actually, I would like to come back to the origin of the symmetrical production profile. Actually, this is the Hubbert method, and Hubbert found its inspiration in biology, where growth in some pattern and logistic growth actually is a type of growth you find when conditions. The first one is that you have a saturation level or a limit, and here we can say that oil is a finite resource. And the second condition is then when you arrive close to the limit, when you approach the limit, it's more and more difficult to reach the limit, and thus growth slows down. Thus, it's what you see here for Norway, where you have cumulative data for discoveries that are in production, or for production itself. But logistic behavior, you can observe it most of the time when you have many fields, and also when the growth rate is low. If the growth rate is too high, you will not observe a logistic behavior. You will thus obtain an asymmetrical production pattern. I can show you the following picture. If you see here, I don't know if I can use the pointer. Is there a possibility to show something, or do you see my?
Yes.
Okay. You have the logistic function that is represented here. And the derivative of the logistic function is the bell-shaped curve. It's not a Gaussian curve. It's the derivative of the logistic function, whose equation is here at the top. And what we can do is to linearize this logistic function. Thus, what is interesting is that when you have part of the data of the past, you obtain a straight line, and when you extrapolate to the horizontal axis, you get an estimate of the ultimate. But also, what is important for us is when you extrapolate to the vertical axis, you obtain an estimate of the logistic growth rate that is here in the equation. And what we observe here at the beginning of a production curve is that actually the logistic can be approximated by an exponential function. Thus, you have an exponential growth with a rate that you find here on the y-axis. But this is true for the rise of the curve, but this is also true when the curve goes down. Thus, the tail end of the production curve, you obtain the same growth rate, but with a minus sign just before. And for conventional oil in the US, what you find is that the growth rate is 6.5% per year. Thus, it's a low rate of growth. But for tight oil, it's about, I don't remember exactly the number, but it's about 20 or 30% a year. It means if you consider that the profile is symmetrical, it means that at the beginning, the growth is about 20, 30% a year. But also in the decline, at the end of the decline, the tail end is a decline of 20 or 30% a year. But for me, it's not possible because when you look at the profile of the individual wells, they do not decline by 20 or 30%. And a composite curve cannot decline faster than the wells that compose that curve. Thus, for me, the decline will be slower than the rise. And thus, we will have an asymmetrical profile. I have here only 2 slides to show you, to explain what I want to say, but for a longer presentation, I can have more slides. But for me, this is the reason why we will have an asymmetrical profile and a slower decline than the rise. Because the growth rate, when you apply the logistic model, is too high. Thus, of course, the first part of the curve can follow the logistic profile with a rise of 20 or 30% a year, but the second part of the curve must go really slowly down. And thus I have a question for Art, because he has shown an asymmetrical profile, and you mentioned an ultimate maybe of 100 billion barrels that's possible to extract. When you bit your curve, have you used this value to build that curve? That is, the area below the curve must correspond to the ultimate. Art, I don't hear you. You have cut your microphone.
No, I think Andrii.
Art, if you wanted to respond, yeah, okay, go ahead.
Okay. No, what I'm showing is not based on logistics or Hubbert linearizations. It is based on historical production, and then I've used the projections of both the EIA and the IEA. I've also looked at Rystad, and I've looked at Shell, and so this is not a statistical. I mean, there may be statistics behind the scenes, and and I'm sure there are, in fact, in some of those agency projections. But I'm just saying, somewhere in these other projections is a partial truth, and I'm simply anchoring my future with what those guys are saying. My sophistication capabilities are for reasons of finance more than anything else, are a lot smaller than the IEA, the EIA, Shell, Rystad, etc. And one other comment I'll make about Rystad. Rystad is a commercial organization, all right? And so Rystad makes money when people are afraid that we're running out of oil. And I know the president of the founder of Rystad Energy. And he's a very smart guy, and he understands marketing extremely well. So if we're going to dismiss the EIA because we don't believe their numbers, I would say Rystad is equally suspect, at least equally, on the other side, because their profits depend on people freaking out about supply. That's how they make money.
Rystad is optimistic.
I hear you. So I wanted to do. So sorry, Dusty, you've been waiting so long, but I hope you can bear with me another 10 minutes. I just wanted to do my quick presentation here about transition. And so I consider Jean Laherrere's to be some of the best data that's available on the planet. And because it aligns with a lot of the other data that I'm familiar with, like John Peach's data and the Rystad data. And so I broke it down based on like years into like 5-year segments and things like that. And then using, this formula of what we know about how oil price declines affect food prices and things like that. And so here's a rough table of estimates of what would happen at different stages. And so at $3 to $4 liter then we could have rail, for example. And at $6 to $7, many people would relocate to rural areas. And here I have it for Canada in particular. And so this is the bottom quartile of people. So the lower 25%, and this is the median food Q2. And so right now, in the 2015 to 2020, everyone was doing kind of peachy. And up to 2020, they were doing fine. So here, I didn't have enough room to show all of the columns, but basically, at both of these periods, the discretionary income of the Q1 was about 8 to 9%, and so things were fine. But now, at least in Canada, food prices have gone up enough that it's now taking 57%, and also land or housing prices have gone up. So actually, in Canada, the bottom quartile is would need to borrow 25% if they were to meet both housing and food needs. And so we have 25% of people going hungry in Canada or skipping meals and things like this because, well, they can't afford to both have a shelter over their head and to eat at the same time. And so and then basically over here, you can see the 2030 to 2035 here. I actually broke it down into play-by-play, a kind of a year-by-year. And so in the 2020 to 2025, this is kind of based on a presentation from the Great County, and we made a makerspace. So that's really great. But yeah, food prices rose 24% in that time. And the bottom quartile can't afford food and housing. And now 2025 to 2030 is kind of considered plateau years. And then industrial food prices set to rise about 5% a year if we maintain peace. And then Canadian median spending So this is that second quartile would be 25 to 35% on food, and bottom quartile would be 55 to 70% on food. And if for the transition, and Mathis is here still with us, so 6% would be of Canadians should transition to growing food, because right now it's 1.5 to 3%. And then 2030 to 2035, so the bottom quartile will be spending 70 to 90% on food. And at that point, they are much more likely to revolt, or, you know, if basically rural transition will have to begin or society may collapse. So we should aim for at least 12.5% of Canadians with enough land to grow their own food in the 2030 to 2035 range. And we could also start building rail, because it will become more economical than driving. Like the drivers will be carpooling and things like this. So 2035 to 2040 range. So oil production is declining at 2.1% a year. Gasoline prices are $5 to $10 a liter. That's $18 to $37 a gallon. Food prices going up 8.5% a year. And so over here, the median Canadian is spending 50 to 70% on food, and the bottom quartile is 70 to 100% on food. So like right now, some of the bottom quartile families are living, you know, with other, you know, bottom quartile families, and so they're able to mostly do food. So basically, at this point, we need 25% of people living in village homesteads, or society will collapse. So for the French Revolution, for example, was when 70% of income was spent on food. Then 2040 to 2045, so gasoline prices $10 to $20 a liter. But actually, at this point, FT gasoline, Fischer-Tropsch process, becomes economical. We can do it at $15 a liter without fossil fuels. And then industrial food prices would be rising at 90%, and the median would be spending 70 to 100% on food. So about 50% of Canadians would have to be village homesteading, or society would collapse. And then 2045 to 2050, it's basically kind of a continuation of the trend, and 75+% of Canadians would be homesteading in villages. And then I have these global land allocation changes, and this is kind of what I wanted Mathis's kind of input on, though I know it might be a lot to take in one go, but the idea is that we could take the current amount of land and shift a lot of the pasture into food forests, and then still be able to make enough yield. Because right now we have high yield crops, 3 tons per hectare, but we're going to have lower yield without fertilizers, which is 1 to 1.5 tons per hectare. And so here you can kind of see the numbers. And but this is kind of a rough estimate, but you see it still adds up to 13 billion hectares. And then this is a more refined estimate just for Grey County in particular. And so actually Grey County would actually increase in population from 100,000 to 212,000 as a result of outmigration from urban areas. And the total kind of fuel would be much less, but you'd still have enough to do, like, you know, power chainsaw or some basic stuff. So that's 5.8 million liters per year. But this is assuming you're basically using every single hectare. And then there's firewood energy, and then yeah. Okay, so any comments on that presentation, or Simon or Mathis, if you guys, that's usually kind of your Simon, you got to unmute.
Yeah, so what I'm
there.
Yeah, hi everyone. So when I went down the oil rabbit hole a few years ago, I found myself in a hall of mirrors very, very quickly. Like untangling the data. What exactly was I graphing? And so it really does take someone who knows what they're doing to untangle this. Right, and so I still every now and then find myself graphing stuff again. Do I have it right? this is a deadly serious thing. What we call peak oil has to evolve, because now we've got other products on the market that are doing it, and the current US direction for oil production might actually produce a spike short term. It's just the question is, will it help us and how much and what form it takes? And I take the point that the conventional oil and unconventional tight oil is actually the same thing. It's just a different extraction method. You know, that's fair enough. I do have something to add. I picked up an idea from Gail Tverberg, and I actually have taken it further. And so when everyone else is finished, I can present a chart that adds something to this. Is what happens when you put population into this method. Anyway, this is good stuff, and we really do need to have a meeting of minds. And Charlie, you're absolutely right. We've got to do this in good spirit, where we actually sort of help each other. I came through a debate, I think it was yesterday, with some trolls who they're trying to have me fired and cancelled, and it was full of gotcha moments, and it was done in bad faith, and yeah, I sort of not interested in dealing with that anymore. But everyone on this chat has something to contribute. So yes, I think it's a great idea that if we could do things in a way that's professional. We all want to be professional. We all want to work with professionals. None of us want to work with idiots.
Amen.
Yeah. Anyway, that's the thing. That's all I have.
Yeah. All right. Thanks. Okay. So I see Ivor and then Mathis. Oh, Ivor seems to be away. So Mathis, go ahead.
Thank you so much.
Do you want to unmute?
I think I'm unmuted. Can you hear me?
Mm-hmm.
Yeah.
Yeah, we can hear you.
Thank you so much.
Mm-hmm.
Fascinating conversation. Just something basic. So what we just do accounting. So we're looking backwards, comparing every year how much is being used from nature compared to how much nature can regenerate. And it seems to me as a general principle, as you have an expanding demand, the system overall is more easily stable and you have kind of smoother curves. Once you get into contraction mode, all bets are off. It becomes unstable. Like we are now in a situation where humanity cannot thrive without getting out of fossil fuels because of the climate threat, you know. And we're also in the situation of humanity cannot thrive without having the resources. So these tensions just make the system unstable, and how it then plays. I don't think it plays out orderly that you can then say, okay, how will people move? But it's just a tension that then it's hard to kind of predict. So I think the nature also kind of symmetry falls apart just because of that, because a growing pie is much easier to govern than a shrinking pie. And that's what we also see now in the political situation. If you look at the political themes around the world, but particularly, for example, what was discussed in the US election, I think they're all linked to overshoot themes, you know, inflation, which means it's harder to fill the stores, fear of immigration, fear of others, positioning with others, feeling the competition, trying to push out more energy because the finance is getting tight. Geopolitically, the alignment according to resource availability and not anymore around kind of other principles like human rights, etc. So that's why I think kind of just getting too predictive around it, how it goes down, is much more challenging than just symmetry.
Yeah. Well, Mathis, I was just wondering what you thought about this. Is kind of like would be a planned transition in terms of helping people move to the rural areas. Do you think that's viable? Because I know you did the ecological footprint, and so this has a lot to do with that, in my perspective, at least.
The more things get chaotic, the less likely you will have kind of organized transitions. So I would say that it's more useful to look at then the pressures we see as context, and then to ask for every entity, whether you're a city or a company or a household, what's going to be valuable in that future. And so to encourage those who kind of prepare themselves in ways that are consistent with that context, which is also, and those strategies that are most successful in I think, are those that are actually not in competition with each other, which would also be the ones that are more helpful to take pressure out of the system. So I think it's hard, it's hard to convince people to kind of coherently move as things get turbulent.
Mm-hmm.
So it's building resilience for the
well, right now I'm working.
Mm-hmm.
Yeah, right now I'm working with the Gray County, well, at least unofficially, and I'm planning to run for mayor of Owen Sound, and so the Gray County is kind of our region, and so I was hoping on getting it locally started here as kind of a model for other people to emulate after. You know, if they manage to wake up in time. What do you think of that? With helping people move, and then one of the things was family radio service. So the idea would be that so right now we have the municipal government, and they have 22,000 people under them, and so like each block would have a block leader, and then 6 blocks would make a village, and then there would be 10 villages in a neighborhood, and then that way each counselor could be managing a neighborhood, and if someone has an issue at a block level, they can escalate it upwards, or like it eases the communication and can use handheld radios so that you're not dependent on internet, or and you don't have scam calls. I don't know if you had any reflections on that.
If you're going to run for mayor, you're going to need a haircut.
Or well, I forgive you. That's what I can say. It's part of my religion, so that's not going to change. But yeah. All right. So okay, Dusty, did you have a question?
Yeah.
Question?
Yes.
Dusty Green.
Well,
Can you hear me?
Your hand up for a while. Go ahead.
Can you hear me?
Oh.
Can you hear me? Anyone? Yeah, Art? Okay.
Yes, I can hear you now.
So I had some questions for Art and stuff, but I'll save that for later. This kind of, now that you're on this topic of this transition type thing, I'll readjust with something that I was going to mention to Simon also, but he might be gone. For me, your idea is very interesting. The one thing I would possibly recommend is at some point changing your perspective to switching to marketing, if you will. So if you're trying to get people to do something different from whatever they're doing now, it takes a huge amount of marketing, especially if you're trying to move to somewhere. So a lot of times what I've noticed when I see ideas like this, they're done in a very new way, and they're trying to change too much at once. And sometimes like they're trying to change, maybe a whole entire new way of doing things, or change a whole entire political structure. And, they're trying to change technical things and politics and so many things in one shot that a lot of times they just end up nothing happening. There's a project many of you guys probably know, the Venus Project. I view that as one of those type of things that a lot of times they try to do too many things at once and nothing happens for 40 years. So that would be my only maybe recommendation. If reality is really what you want to be affected, then at some point marketing and making a lot of compromises is what will probably be necessary.
Okay, well, thank you, Charlie. Sorry, Dusty, and Ivor, you had a question as well. But I agree with you, Dusty, that it's good to do incremental changes, and I'll be going door to door to see what people are kind of ready for.
Well, that's what I was going to talk about. Is
go ahead, Ivor.
Change. I had the idea.
Well, I can't hear him. Can you guys hear?
Can you hear me? Can you hear me? Yes. No. Can you hear me?
Yeah.
Okay. I do. Good. I had the idea. I actually got it from.
Go ahead.
Can you hear me?
The video can hear you.
Okay, good. I had the idea up in Quebec. They have small food forests called érablières, or small forest. And the beautiful thing about a small forest is it's a family-owned thing. Usually, it's usually owned by like a family or a group. And then people will go to this érablière, and they'd be making maple syrup in the spring, and they can, we're able to create a kind of a communal forest that actually works for people. And we had one for 20 years, and it became kind of a community center. People would come in the spring and visit our sugar house, our maple sugar house, and we would cut wood out of there. And, I did it with a friend of mine, and we're both kind of middle-class guys. And we found that it worked for us because we got wood for our houses to heat our houses. We got little things like shiitake mushrooms we grew, and of course, exercise and maple syrup, which is a really useful product. So it was a useful little farm for two regular people. And I think we've got to start to think in terms of that, encouraging useful farms for families and regular people. And instead of buying yourself a wave runner at this point in humanity, you better just quit that and see if you can get a couple acres and make yourself a food forest or a way to live, because it's getting close now. It's getting tighter and tighter. That's my opinion. But I think it's got to be a communal effort and not just each, how the rich people are now kind of grabbing up huge swaths of land. If we can grab up a little spot of land as a community and live on it, I think, and live off of it a little bit, it would be better. And it's ecologically friendly. Thank you.
Good. Charlie, I see you have your hand up, and then I guess Simon will do his presentation.
I just wanted to say that Marthas.
Charlie, go ahead.
Can you hear me? Marthas is an old friend of mine, and I visited him.
Yes,
socially.
yes, we can hear you.
I visited him socially a while ago, and I said, look, you and I have invented two of maybe the most iconic, this refers to him much more than me, concepts of ecological footprint in your case and EROI in my case. And I said, have your ideas influenced society any? In other words, have you caused the Queen Mary to move 1 inch from her, or the Titanic to move 1 inch from your course? And he said, well, no, of course not. And I said, neither have I. There's no discernible political influence of the concept of EROI, nor, according to Malthus, the ecological footprint. And then I asked this also Bob Costanza, who's invented the whole field, one can say, of ecological economics. And he said, not yet. So those who think we're going to change the course of the Titanic or the world, here's three people who spent their whole life coming up with, conceptually good ideas, some people would say. And have any of us influenced the course of humanity or their own nation or anything else? And as far as I can tell, the answer is no. And so I'm an ecologist by initial training, a systems ecologist trained by Howard Odum. And I think the only thing that's going to save humanity is running out of fuel, because otherwise we're just going to keep going. And whether it's the maximum power principle, and anybody want to email me on that and I'll send you something, or something else, I think I'm writing a new paper, or trying to, and the title is "What If There Are No Limits to Growth?" This is inspired by art. And I've said to my students for many, many years, the only thing worse than running out of oil is not running out of oil. So here we are.
Okay. Thank you, Charlie, for your statement. And I agree with you. In terms of that, it can be very difficult to make any large changes. And I am just making an attempt with the whole mayor business, and just because I have a lot of support from local people that know me and would vote for me and things like this. And but I'll have to go door to door and see what the willingness there is. And so I know we had promised everyone Steve would present too. Steve, do you want to try seeing if... Yeah, go ahead, Steve. Try unmuting and see if we can hear you. Okay.
You hear me?
See...
Okay.
Yes,
I can
hear.
I'm watching you all on the YouTube. So let me go ahead and share the screen.
Okay.
Where is that again? I did it last time.
So it's the third button on the bottom. So there's a microphone and a video, and then it says start screen sharing. And you should probably do a window because sometimes the full screen doesn't work.
Gotcha.
Okay. Okay.
How's that?
You almost got it? There. Okay, I'm seeing total Permian oil production.
Can you see that?
Yes. Okay, yeah, just stick to this window for now, and then just go through the slides by clicking on them or something.
Okay.
And then we can see
all I want to do is... Okay, the debate is going to continue between the peak oil reserves, the 2P, 1P reserves. But what I want to do here, what I want to do is show for some reason I do not see. Okay.
I see the screen and it looks very good.
We're seeing,
I'm seeing total Permian oil production.
We're seeing the notes, not the presentation mode.
I really do apologize. I cannot. Okay, you see the screen, but
don't worry about the presentation mode.
We've got technical problems on the platform tonight.
Oh, yeah. There's a lot of people on the platform today. That might be part of the issue.
Okay. This is unbelievable. Let me do this, Andre. I'm not going to be able to do it because I can see it on YouTube, but for some reason it's like a whole bunch of different windows going in time. I cannot. So let me go ahead and.
Okay.
Unfortunately, I can't hear anybody or present.
Well, we see it.
Oh, okay.
We can see it.
Okay.
Now,
all right. We could see it. All right, Simon, go ahead. I'll try to talk to Steve next time.
Okay, that's a shame because I was looking forward to that.
Okay.
Wait a minute. I could see it before, but I can't see it now.
Yeah, I could see it before, Steve. I could actually see it.
Because he stopped.
I don't care if it's in presentation mode. This is important. Be
okay.
patient.
The problem is,
Steve, can you just present, and we'll talk about it after in the chat. Okay.
Keep talking. Do you know what I'll do, Andre? I'll send you the slides, and maybe you can put them up. Okay.
Okay. You send me the slides. Okay, that's good. Okay, so Simon. You can present for now, and then when I get the slides, I'll present.
I've got something very small. First of all, I think what we saw from Art tonight and the last couple of times is what we call peak oil has to evolve. We have to sort of move beyond the classical version of it. And I think a more systems approach to the whole value chain of what energy does for us and where do we get it from. We've now got a whole lot of products on the books now that are not actually oil, but does the same thing as oil. Then we've got the things where how oil is extracted. Well, you've now got a spectrum of stuff. And so the classic, Hubbert's peak was great in the beginning, but it's no longer sophisticated enough. And so things have to sort of move along. I've actually got, I think I've got a model for minerals. Like I believe all natural resources will have these same issues at some point. Now, with natural minerals, we're not going to run out of minerals. We run out of capital. We run out of money before we run out of minerals or energy for that matter. And the whole enterprise just stops. Or we are forced onto a different track. And if we look in a systems context, I think the oil industry is being forced down the same way. I'm going to show you now something I've put together. I'm actually looking just at the product of crude oil, and I'm looking in a global context, not in the United States context. And so let me just find it. Okay, I think this is it. Are you seeing? It's a chart in a report.
Total world oil production.
Okay. Right, so this is just some EIA data. It is just crude oil, it is in a global context, and it's just what's been recorded at the moment, and it stops at December 2024. All right, so, and this actually lines up with some charts of some other people. Okay, we've all seen this one. What I've done is taken an idea from Gail Tverberg, who, by the way, our finite worlds data, she's awesome. Her intellect is truly remarkable. And so what we've done here is we've taken oil production on the left and divided by human population on the right to look at oil per capita. And I come up with this chart. So everyone in the world uses oil. We all do. And so it's a global market. More and more people come online, but how much oil is actually hitting the market per capita? Now, Gail put up a graph that actually went back to, I think it was 2010, and she had a localized peak at 2015, which is that little lump there. But I took it back to 1965 just to see what would happen. We got this. So the run-up from 1965 to about 1973 was quite steep. That is, we're bringing more and more oil to the market per person who was living at the time. We hit the 1973 oil embargo, and that's the first sign of trouble we had. Then we had the 1979 oil crisis, followed by the Saudi Arabian oil production cut. They decided to actually just reduce production, and then it fell and it plateaued for a while. And then we had the pattern I found in January 2005, which I've already presented. And since then, it's sort of like on a downward spiral. So here we are down here. The point is this. From a per capita point of view, we've been having less and less oil as each year's passed now for some time. Something like 45 years ago, we've had less oil per person that's just available. So what I was also saying is I'm still trying to get my arms around the implications of this, like the technology associated with this. Is this a new tool that we've got to look at? If so, Gail Tverberg should get the credit for developing it. How does it fit with everything else? I don't know. Anyway, so that's just something to show there. Finally, I do have a bit of personal news. I am no longer a professor. My 5-year tenure at GTK has come to a close, and I'm now a senior scientist in the same organization but a different division. The 5-year contract was just not renewed, and so I'm now moving back into mineral intelligence. So I'm moving away from circular economy, and I'm chasing mineral intelligence signatures. Whatever that means. As in, what does that mean? We'll see.
And
good or bad?
Well, that's an interesting question, because the work to me, they're actually different parts of the same thing. Like mineral intelligence is foresight, insight. Circular economy or industrial ecology is another name for it, or steady state economy is what the hell do we do? But mixed in with that is when I was in that environment, was they were very much stuck in a paradigm where they couldn't consider new ideas. When they're talking about circular economy and recycling, the only ideas they seem to be prepared to look at, and that's what I'm talking about, is all people in the circular economy development groups all around the world. They were very much stuck in a rut looking at how things should or should not be based on what's already done. They could not really cope with new ideas. So I've actually evolved the whole thing into the resource balanced economy. And that's had some mixed reactions so far. Some of the purists want to have me burned at the stake for heresy. Again. And if that happens, I shall retire and I'll become a shitlord class internet troll with a pile of dank memes, and that'll be the rest of my professional career. So
oh no.
Yeah.
Well,
but what strikes me is with the mineral intelligence stuff, this is deadly serious. Like what I think is going to happen to the people I work with is they're going to get a call from Parliament. You know, things like, "We've got a problem, fix it. You've got 2 days." Information is key. Things are happening around the world at the moment, and information is the only way to make sense of it. But what is very clear to me is what that information is must evolve. And I get this horrible, like I went to talk to the French group for a while at a conference, and then I talked to the Germans as well in another group, and everyone seems to be just marking time. They're in a holding pattern. Everyone's holding their breath. Everyone's waiting for someone else to tell them what to do, what to think. And so all the metrics that we're actually sort of chasing and working towards are what things are now, not what they might be if any one of these major things happens. And there's a whole series of things to look at. So the guys I'm now working with within GDK, they're really good. I'm really enjoying working with them, and it really does feel nice to be part of a team. And so we're actually now looking at, well, what are the different countries around the world think in terms of what's a critical raw material? And it's all based on what past markets have actually happened. But when you actually put them up, some countries are prepared to look at energy and other countries not so much. It really is interesting to see the done. Yeah, okay, so that's it. That's it for me. Thanks.
Okay. All right. Well, thank you. Thank you, Simon. Always glad to see your updates. And so I managed to get the slides. And so I'm just going to share the screen now. PQL chat. There we go. Allow. Now you guys see that?
Charlie does.
I don't know if anyone can see that. Simon, can you see that?
Can you make that a little
Charlie?
bit bigger?
Yeah. Okay. How about
Andre?
you, Steve? Yeah. Sure. Here. Does that look better? Because I can't see what you guys are seeing, unfortunately.
Yes, and Andre,
It's good.
listen,
Okay.
I'm going to give this presentation really. Yes, I'm going to give this presentation.
Nope.
Okay.
I heard I'm going to
give
give
presentation quickly
Okay, go ahead.
because I'm doing a feedback loop, listening to live on YouTube, so I can't answer any questions. So let me just. Okay. Okay. Here we go. Okay, so this is the first chart. Art probably knows, he's familiar with Navi Labs. It used to be Shell Profile. And we continue to see, as of November 2024, production into Permian, a little more than 6 million barrels a day. Now, this is just horizontal. This doesn't include oil, the conventional oil as well. So go to the next slide. This is one of the issues. The problem with unconventional, even though we have ramped it up and we'll continue to ramp it up, and is the issue with wastewater. Now, the Permian is different than the Bakken and even the Eagle Ford. There's a lot of wastewater, 8 million barrels a day of wastewater. That was the peak. And so if you go to the next slide, according to Navi, the Permian has produced about 13.2 billion barrels of oil. If we estimate compared to the 18 million barrels a day of water production, wastewater, it's about 40 billion barrels of wastewater. And most of this is not recycled. It's just too expensive. The logistics are not quite there. And so it's injected deep in the ground. And this is caused, if you go to the next slide, not only earthquakes, but now we're seeing reports of abandoned wells spewing wastewater. Fracking wastewater injected underground for permanent disposal traveled 12 miles through geological faults before bursting to the surface. So one of the concerns is the possibility of widespread groundwater contamination. Now, this is a possibility. I'm not saying it's going to happen, but in Norway, we're seeing ground subsidence due to natural gas production. They actually had to cut back on producing natural gas. And now we're hearing about earthquakes happening in British Columbia. So in moving to more unconventional, we're having a lot more externalities that are happening. So go to the next slide. In the chart that Art shows, which came from a paper written by 3 petroleum engineers, I think Tad Przitsky was one of them, the production in the Permian is actually higher now. It's 6 million barrels a day. So there'll be a plateau for about a decade, a lower plateau for 2 more decades, and then maybe a smaller plateau for maybe another 5 years. The issue is, if you look at the black line, it's a little bit longer now because this was done in 2021. Look how much oil was produced and how much water. Look how much more water will have to be produced. We have to get that fresh water, and then it has to be disposed. And even though they're trying to figure out more ways to dispose this wastewater, most of it is being injected into the ground. And I think there's the externalities with pumping that much water into the ground. This is going to be a real issue going forward for Texas and even Oklahoma. Now let's look at the next slide. The 2 externalities of unconventional are the massive pollution, wastewater, et cetera, et cetera. The other externality that's not considered with oil is the falling EROI, and it's showing up in debt. Now, this is the global debt monitor by the Institute of International Finance. 323 trillion now in debt as of the 3rd quarter of 2024. Next slide. So if you look at this is world debt growth since 1960 to 2024. While we can put a lot of ideas of what production is going to be, reserves are going to be, nothing happens in a vacuum. We have to finance kind of steers the economy, energy drives it. So from 2005 to 2020, global debt increased to 150 trillion. We added 16.5 million barrels a day of oil growth, liquids growth. That was 9 trillion of debt per 1 million barrels a day. Now, estimates for 2020 to 25, if we get 4 million barrels a day of growth, that's going to be 14.5 trillion for every 1 million barrel a day of growth. So what's happening, we're adding a lot of debt to continue business as usual. That's a whole presentation for another time, but it's only possible if you can continue to grow production. But if you plateau where we're going to head into, maintaining this debt or adding more debt is going to be very unsustainable. Next slide. So even though we brought on a lot of oil, if we look at how much total debt per oil barrel consumption, in 1980 it was $3. It was $3.66 of debt per barrel of oil consumption. Now we're at 8,646. So what is one of the things that's happening in the background with all the oil production is the debt continues to go up. And this is, I call it The debts are propping up the assets on the other side. And the next slide, please. This is the last slide. If you or I want to go and get a loan, typically you're going to put your home equity up as collateral. The US Treasury is the foundation of global collateral. So people own treasuries as assets, but the US government, that's a liability. It's really a debt. So this BIS paper came out and said that US Treasuries basically are the foundation for global collateral. What's interesting, I mentioned this before once, but if you look at the right-hand corner, they have a footnote. To be clear, in our model, we abstract from sovereign debt risk and considered treasuries as being safe assets. Now, the people who put this paper together, they didn't prove that treasuries were safe assets. They assumed that they were safe assets, and they're safe until they're not. So I think one of the issues that we're missing, two of the issues we're missing going forward, is the massive debt that's propping up the system. And that will continue for a while, but that will become unsustainable. And if debts implode, assets implode with it, and the ability to have capital to continue drilling oil wells. Also, at the same time, we're seeing the externalities of massive amount of water, wastewater, earthquakes. These are things that are giving us signs. This kind of continued increase of oil production, especially Permian shale production, I don't believe is sustainable. So that's the end of my presentation. I'm going to see if I can listen back to YouTube. Thank you.
All right, thank you, Steve. That was a great presentation. So I'm seeing, okay, Art Berman has something.
Yeah, thanks, Steve.
Go ahead, Art.
That was very interesting. So a couple of things I'd like to clarify. The first is you call it wastewater, but it's produced water. Okay, I mean this is water that comes out of the formation. It's not. I mean, there's nothing. It's not like pollution or anything. It's salty for sure. Now some of the water.
It's toxic. It's toxic. You know that. It's toxic wastewater.
It's salt water, Steve.
It's
connate water. It's produced from the formation.
When wastewater comes back with the oil, it's got oil in it. They separate that out. It's toxic wastewater.
Okay, you can call it what you want, but I mean it's okay, so fine. The other thing is that debt. I mean, debt is not. I mean, the debt is not because of oil production. I agree with you that oil. I mean, that there is an underlying. I mean, all these monetary claims that we make in the form of debt ultimately have to be. I mean, they're eventually denominated in energy because that's the currency of life. But I think there's the debt, the massive increase in debt that we've seen in the last 15 years is because of the collapse of the financial system and COVID. I mean, those are the two largest contributors. And I'm not disputing that debt is a problem or that debt ultimately is somehow related or has to be paid back in terms of energy. But I think it's misleading to express debt in terms of barrels produced. So that's all I really have to say.
No, I appreciate your reply, and I think if I could say, it's very difficult. Everything's complex, right? We've got technology. Technology's helped a lot. The funny thing is, I do forensic analysis for Bitcoin mining. It's the most capital destructive industry in the world. In 2 years, those Bitcoin miners, 90% depreciation. And so I knew that this is technology now, right? We're going to have the White House is going to have the crypto Bitcoin summit. And the problem is a lot of these Bitcoin miners, they're using technology, but they have ramped up their mining fleets to such a high number, they can't sustain them because the depreciation is so great. They've got to replace them every 2 years. So you know what they're doing now? They're going to move to AI and hyperscale data centers. Well, do you know when an AI chip lasts? 2 years. When you put AI and you're doing all these very complex chips and you're doing AI, they only last 2 years. So the economics of data centers are just as bad as Bitcoin. And then banking servers, they last 4 years. Federal Reserve note lasts 8 years, and a gold coin lasts 30 years, but you have to remint it when it's worn. So technology has helped us, Art. I do agree with that. But we're moving faster and faster and faster just to keep the system going. And I was just showing how debt is a measurement of the barrels of oil consumption. And so at some point in time, the debt will not be sustainable. And when the debt falls apart, the assets fall apart with it, and the ability to continue producing oil because the capital won't be there. I think this is a major issue that is not factored in.
Yeah, and the other point I guess that's related to that is just that, I mean, oil is in the process of being nationalized in the United States. I mean, that's what Trump's really talking about. He won't say it, and it's not going to happen overnight. But we are going to be dedicating increasing amounts of our capital toward producing energy, because no government, whether it's the U.S. or China or whatever world order we end up having, no government can stay in power if people don't have enough energy. So this is another reason why the Hubbert curve doesn't really apply in a financialized world. That governments are going to dedicate whatever amount of public money is needed to providing whatever energy is available. And that may mean that we've got like almost no social services left. Again, I don't dispute anything you're saying, and technology is clearly not going to save anything. We're in a thermodynamic shoot to hell. There's no question about it. I'm just trying to put this in some perspective that to try to, and I'm not directing this at you, Steve, but to try to take peak oil as some sort of partition segment that's reflective of geology and reserves and all of that, without considering the systemic aspects, which is I think what Simon's talking about. You can't do it. I mean, capital and oil and energy, and the whole thing is tied together. That's it.
Yeah, I agree. I just think, though, they're not separate. You probably know who Mike Shellman is, and produced the conventional oil wells 30-1, was able to provide taxes for the local government. So now we've moved to shale, and it's definitely kept the system going. I mean, look at the United States, 20+ million barrels a day of liquids. Unfortunately, what's happened to do that, the externalities have not really been appreciated. And I think as we continue to remain in that plateau, we will. I agree with you. We'll remain in a plateau longer than we realize. But I think the issue is that debt is going to really impact us in the next several years. So the debt will pull the plug on the oil due to the falling energy return on investment. It's really that simple. It's kind of like the left hand doesn't understand what the right hand is doing. And you can't really measure that EROI, but it shows up in the debt. And also, Art, last thing I'll say, when you look at Exxon and Chevron, you look at their upstream earnings compared to their capital expenditures, compared to the non-upstream oil, it's much worse. They're making much more profits on their non-US upstream oil and gas production than they do in the United States. They're spending a lot more capital and getting a lot less earnings. That to me suggests that the EROI for US shale oil is not as high as the non-US.
So I wanted to say that I think that one of the best proxies I found for EROI is actually food inflation. And I think when I was doing the numbers, crunching the numbers on projecting food inflation, I found that it's not based on the oil supply itself, at least not strictly. because the food inflation has been so high. And I think that it might be very correlated to what you were saying, that debt is what's causing the excess spending by the government is causing that food inflation. And I don't know if maybe in the future you could look and see if there's a correlation. But I know Dusty has his hand up for a while now. Dusty, go ahead. You got on mute. You got on mute, Dusty. We can't hear you.
All right, here we go. I'll try to make this as simple as I can, just so you guys get a perspective of where I'm coming from. I am a pretty normal Midwestern guy, somewhat right-leaning, but I had one foot in very left-leaning, technological focused YouTube channel for a few years. I was the producer for 2-Bit Da Vinci, so we focused on that. And when I hear all of us discussing this stuff, data was something that was really important on our channel, but messaging also becomes really important. So when I hear a lot of this data, just from a normal guy perspective, it's all extremely important and we need it a lot. Like, I'm very curious what new forms of EROI, that Charlie started out. How can we simplify EROI? Like, I look back and I think of, the gushers of Pennsylvania being near railroads, being near refineries, and then what are we doing now? There's definitely a change from what was going on back then, that really sweet EROI, easy energy, to the complex stuff we're doing now. And Hugo mentioned in the chat, local peak oil. So how can we look at, how can we combine EROI type mentality with local type peak oil thinking? Like Europe, for example, how are they getting their energy? Where is it coming from? What's the EROI of their end use energy in Europe? And that's kind of some of the remessaging, like Simon mentioned, that we need to find that data. Like a lot of people are amazingly doing here. Like, the data is just amazing. The art does it and the rest. But then how can we simplify it for a normie to understand? Wow, Europe's in trouble. Their EROI is bad. How can we repackage that? It's kind of a end question here. I don't know if any guys want to comment on that.
Yeah, it's just Steve has a bit of a delay, so I don't know. I think he'll respond when he can.
I think Charlie was.
We're all saying the same things from different angles.
Okay. Oh.
Yeah, I just want to clarify
Art,
sorry. No, go ahead.
Go ahead, Art. You had your hand up next.
Yeah. Gushers are because there's no fluid in the hole. Okay, there's just air in the hole, so there's nothing to hold the pressure back. So a gusher doesn't mean that production was better. It just means there was no control on what came into the hole. So that might be a superficial issue, but you can't correlate uncontrolled wells with good production. That's my only point. I mean, if we didn't have fluid in the hole right now, I mean, there'd be gushers. I mean, if you can produce 1,000, 2,000 barrels a day from a Permian Basin well, if you drilled it with air, I mean, there'd be gushers, 5 times a day to be, pretty unmanageable.
Yeah, drill mud's very important to the drilling, Art. I'm sorry to stand going. Drill mud is very important to drilling.
Yeah. Yep. I guess what I meant, Art, by gushers, I was meaning it kind of colloquially, just that people found, that they're digging a fence post and, whoa, there's oil, that sort of ease of it at that time. And I guess a question would be too, are we going to find those kind of wells in the future? Or is that easy stuff gone?
Well, I mean, it's a Pareto kind of principle that the so-called low-hanging fruit is always found first, no matter what we're talking about, right? So no, there's no question about that. But at the same time, I think the obvious retort to the EROI point that Steve brought up is um, companies are drilling not based on EROI. They're basing their drilling on where their capital return is greatest. Okay, now, I don't want to debate the 10Ks or the 10Qs of these various companies, but I mean, a company like Exxon or a company like Chevron is not devoting a substantial portion of their budget to drilling in the Permian because they're not making money. I mean, that's just, EROI is great and I love it. But companies don't look at EROI, and your comment, Dusty, about the average guy. I mean, the average guy doesn't even know what we're talking about with EROI, nor does he want to know. Okay, so that's all I have. I think there are some real problems with the practical applications of EROI, not because the concept isn't valid, but we just don't know enough of the costs going in. And I want to go back to what Charlie said about, Adam Brandt's Bakken study. I mean, correct me if I'm wrong, Charlie, but what I remember was he was finding EROIs in the Bakken of, 25 to 50 to 1, depending on the accounting method. So, I mean, the idea that tight oil is somehow, right on the, the borderline of being EROI disaster simply isn't borne out by any kind of studies. That's it.
And I just have a quick question for you, Steve and Charlie.
Charlie? Oh, go ahead.
Is what I'm hearing from Steve is that the reason EROI for a group like us and people trying to actually figure out what the future is going to hold, the reason why that's important is because there's a lot of, let's just say, financial mirages or uses of the financial markets to cover up reality. And so that's where, and how long can you cover up reality for? So like you mentioned, Art, if a company is able to do X, Y, Z to get energy because financial realities have made that the case, what is the physical reality when we're talking about EROI? And I guess that's where these kind of things overlap. But I think for a group like us, I think we're predominantly more interested in the physical reality and then trying to figure out and see how the financial markets, et cetera, play with that physical reality. Is that?
Who'd like to take that one? Charlie, how about you? Because you have your hand up too.
Well, Dusty, email me and I will try to help you. chall@esf.edu. chall@esf.edu, and we'll see what we can do. I think that there is less uncertainty in EROI than a lot of people think, and we're doing, we've just published a paper in Nature Energy, and we're dealing with that in some more detail. And yes, Art, I agree with you very much. I think that the vertical wells had an EROI of less than 10 to 1 in 2006 and declining. And that fracking came on and had a peak at maybe 30 to 40 to 1, but then started to decline. And if we extrapolate that decline, then it's probably less than 20 to 1 now. Fracking saved our ass in more ways than one. And so I agree with you very much. And the question is, how long is it going to last? And I'd really like to be able to figure that out. I think we can do it if we can get the data. And it would be nice if we had a little bit of money to, I mean, I don't have graduate students to do my sweat work anymore. And that's a problem, but I know how to get it done. I know people who can do it. If, $10,000 would buy you a lot of good work. People looking for the numbers. And the problem we have in the United States is that we used to get really, really good data in the Bureau of Census analyses. And the the data, and we've published on this, the data that we have to work with is not nearly as good as it was back in 1980. And so that's a problem, but we can get around it in various ways. Dusty, I think we've got pretty good data for you. And I think we also, an important thing is the methods of getting EROI from imported oil, which is increasingly important for Europe. And the relation between the prices of things you import and the prices of, like oil, and the things that you export, and how much oil does it take to make the stuff that you export. And we've done all that work and published it with DFID in England. So a lot of these things we can do a pretty good job on. And there are three different ways that people have looked at EROI using CO2 estimates, which European companies are required to do, using financial estimate, which Court and Fazane have done, and using physical measurements as we have, and they all come out in not only the same ballpark, the same infield. They're not terribly different. So I think we have a pretty fair idea. But I will include, I'm going to send out something to all of you with my responses to various things. And it's got a number of papers attached. Don't bother to read the papers unless you want to. Just look at the pictures and the graphs, the data that are supplied. I'll be quiet. Maybe, Andrii, I should come back sometime and for this group do a assessment of where we are with the ROI.
Sure. Yeah, maybe next month. Yeah.
And Dusty, I want very much to help you.
Very good. Thank you. And I know Steve, he wants to respond to something. Steve, are you ready? I've got the slide here that you wanted.
Yeah, and maybe Art can provide some, his own comments. But when I look at the data, when you look at ExxonMobil, what you could see here, and the non-U.S. Production for Exxon is higher, natural gas and oil. But what you could see in the fourth quarter, Exxon spent almost $3.2 billion in capital expenditures. And most of that is because it's more intensive drilling to produce shale wells. Only spent $2.5 billion in non-U.S. But look at the earnings for the United States. The upstream earnings was only $1.2 billion compared to $5.2 billion for non-U.S. Now, part of it, there's more production overall, non-U.S., and they are getting a higher natural gas price, maybe a higher Brent price, but that's still, it just shows you that they're using more capital to get less revenue, less earnings from their upstream, which is oil and gas wells. So I just wanted to show, we could see that the data shows it right there.
Okay, go ahead, Art. You want to respond?
Yeah, you can't compare 4Q to 3Q, Steve. You can look at, at 2024 to 2023 production revenue. It's highly variable between quarters. The other thing is that, Exxon's got a lot of really crappy old production in the United States, and so again, these are not stupid people. They are putting a huge amount of their E&P budget into Permian drilling, and they don't break it out in there. A lot of companies do. The independent companies will ordinarily let you see. They'll break out Permian separate from international operations. Exxon, Chevron, those companies don't do it. So I think it's, I take your point, and I'm not disputing it. I just think that you're getting into some pretty shady or dubious areas when you're trying to compare the average of all U.S. production and earnings to all international, because you can't segregate them, and Exxon's never going to tell you the right answer. Compare 10K to 10K. Compare 2023 to 2024, and take a look at a company that actually does tell you, an internationally based company that does tell you what they're making in spending in the Permian versus somewhere else, and I think you'll get a different answer.
Well, you're right, and I actually did that. I looked back in 20, 21, 22, 23, and there were years that Exxon, their upstream earnings in the United States, they lost money. Their earnings were negative. So it's better. It's better now, but I have looked over about 4 years. And so some of their U.S. upstream earnings were lower. Now, part of that has to do to, as you know, low natural gas prices. But that's starting to change because, Biden, he wanted to put a cap on LNG export facilities, because now I think the most recent number, according to the EIA, is we've exported 16 plus billion cubic feet a day of LNG. And so now we're not seeing enough increase of U.S. natural gas production. So it's starting to show up in the price. And I think this is another aspect. So yeah, I have done, I've compared different years, and actually Exxon's done a little bit better compared to when oil prices were lower. They actually showed negative earnings compared to their non-US.
Okay. All right. Well, we're pretty far over time, and I wanted to give an opportunity for Dan to give a brief teaser of his presentation that he's going to do next month, and then let Jean do the closing statement. Dan, are you there with us?
Yeah, I'm here. Can you hear me? Can you hear me?
Yes. Yeah, go ahead.
Go ahead. So you've got a rather diverse, interesting picture group here. So my background is probably very different from most of you here. And I'll give you a quick teaser about myself, and then I'll talk about Stan. So Stan Osman, he's talking about, that's General Stan Osman, Brigadier General, United States Air Force, retired. So understand I come out of basically Department of Energy and military labs. Most of my family is nuclear Navy. I try to avoid that. I was in air defense in the service back in the 80s. I still ended up working Department of Navy.
Can you turn on your camera?
I'm sorry?
Can you turn on your camera?
A second. There, can you see me?
Yeah.
Okay. So I ran BG 101, and that's a Tomahawk cruise missile, for 6 years. I own 4 patents in GPS. I ran Tomahawk Trident 2 for about 2 years. Went to the public utility sector at Indianapolis Power Light here in Indianapolis, and my mission was to basically automate everything that was bolted down. My next project was Mid-Continent ISO, so I'm the guy that designed the computer system that controls the power grid for 26 states and parts of Canada. Was at General Electric for about 2 years, alternative fuel program, working on the LM6000 gas turbine. Got to convert 4 coal-fired power plants over from coal over to gas turbine. Literally for a couple of years, about 2013, a lot of people asked me to get back into the energy game. I have 3 companies. I provide services for the natural gas grid, probably 6 or 7 co-ops, banks, hospitals, government, that type of thing. So I'm going to do a presentation. We're going to start with Stan. We're going to talk about the infrastructure of the oil and gas business. And I've actually, been there. The guys are actually drilling wells and been at oil refineries and fight with the petroleum engineers as to where I get to put my gas turbine for powering the refinery. But I can also talk about some other forms of energy that most of you don't consider. And one of the reasons why we've been focusing on certain things, either the military or the Department of Energy. And that's what I've got for when we meet next time, I guess in April. I think you asked if I worked on the internet project. Yeah. I was 14 years old. My dad was out at the Idaho National Engineering Lab. I had a research scientist gave me a 9-track reel-to-reel tape. I loaded on a DEC PDP-7 mini computer. That was machine number 11 in the National Science Foundation. I had a direct connection down to Texas, no in General Atomics. In those days, they used UCP for email. And so a lot of those internet standards, you're going to find John Postel, the real father of the internet, on there, Dr. David Bills, and myself on all those standards, and of course hundreds of other people that worked on building the internet.
What's your name again?
My name is Dan Gowin, Gowin. The easiest way to figure this out, go out to Google, type in RFC 1708. RFC 1708. That's a PIX performer for GPS. That's what that is.
Wait a minute. Hang on. I'm gonna do it.
Okay. Here, I'll share the screen.
Sure.
Okay. Well, we'll figure it out more next time.
Sure.
Nice to meet you, Dan. Say hello to Stan.
RFC 1708.
That's a PIX it's for GPS receivers is what that's for. GPS satellites broadcast the time, if you didn't know.
Great. Okay.
We use that in power plants, if you didn't know that. To synchronize the
Okay.
power.
Well, thank you.
Can do.
Cool. All right. So, Jean, would you like to do closing comments for today? Jean Laherrere? We can't hear you. Are you unmuted? You're still muted. You have to unmute. Jean, you have to click the unmute button. It's in the bottom left.
Okay. It's good.
There. Okay, now we can hear you. Very good. Thank you. Go ahead.
Okay, now the study that I'm doing now is not about energy, but about resources in metal. And I think we can apply exactly the same technique on metal. And the thing is going to be, I'm going to post a paper very soon on metal forecast.
Okay, great. Thank you. Did you have any other closing remarks before we end the show for today?
No. It's very interesting.
About the discussion or no? Oh, that's good.
It's good.
All right. Okay. Well, with that then, as we found you, we leave you in the love and light of the one infinite creator. Go forth, therefore, rejoicing in the infinite power and the infinite peace of the infinite creator that is within you and all around you, my friends. All right. Okay, I've ended the stream.